Welcome, Kellogg community. I'm Michaela Doyle with the Kellogg School of Management. Thank you for joining us today for Conversations with Kellogg Leaders featuring Bon French. In this webinar series, Dean Corneli speaks with Kellogg alumni leaders on timely issues and challenges facing the global business community. You can catch up on prior webinars in this series at our virtual events page on the Kellogg alumni website. We will put a link to that site into the chat now. Today's presentation will last 1 hour. We invite you to submit questions for our speaker at any time using the Q&A icon that's located at the bottom of your screen. We will address audience questions throughout the conversation. And with that, I'm happy to welcome Dean Francesca Corneli.
Hello, everyone. Thank you so much for joining us today. And actually, I also wanted to start by saying for those Kellogg alumni with a house in Florida on the path of Hurricane Milton, we are thinking of you and hoping for the best. But today it's actually a great time to spend with another incredible alum, and this is such a privilege. And this alum is someone I heard about him way before becoming the dean of Kellogg. Bon French is the chairman of Adams Street Partners. He is being, a leader in the world of private equity. He is getting, recently I've been seeing him getting so many accolades, so many prizes. And I know recently, very soon you're going to receive the Hortense Friedman Award at the CFA Society. And as many of you might know, when I was in London, I was focusing on private equity. I used to teach a case study on Adams Street Partners, and I heard a lot about Bon French. And what a surprise when I became the dean of Kellogg to discover that
he exists.
He still exists. No, he is my alum. It's such a, it was such a welcome, a wonderful surprise. So thank you, Bon, for joining us today. It's great. It's great. So now we have a lot to learn from you. You've been at Adams Street 44 years. You had incredible success, phenomenal growth. So you really have a lot of experience in leading teams, growing the business. And I heard you describing your leadership style as inclusive and collaborative. Can you tell us a bit, how did you develop this style? How you think about it?
I think I was born with that. It's been the case for a long time. So it wasn't something that, occurred 20 years ago. It was something that I thought about 40 years ago. I don't know that it was such a conscious thing in my mind as it's become over time, but I think it's just very important. Private equity, is in venture capital, I would include under this heading, of course, is all about investing in people, in general partners or management teams, entrepreneurs. And you can't look up anything, on Bloomberg, right, in terms of valuations or prices. And so it's all about working with people to understand their businesses, to get information, to understand how to invest. And yes, we're analytical and we think about balance sheets and income statements, but I think bringing teams together to share information and having a collaborative style, not just internally, but externally, treating the general partners as clients, actually. And I did that 40-some years ago when there wasn't a lot of money and they were desperate to have to find investors, actually. So it's been a long-term tradition and reputation at Adams Street to actually be the whole firm to be collaborative with our clients and our general partners and our portfolio companies. So it's not just an internal situation.
This is so distinctive. Would you say this is a very different style from the rest of the industry?
Well, yes and no. The private equity and venture industry really are almost entirely organized as partnerships. And so in that sense, you would think that it would be very inclusive and collaborative just by definition. And generally speaking, it is. Some partnerships, if you think about the managing partner, are more inclusive and some are less. And so that varies. So there's a wide range in terms of how people allocate carry to younger people or even the ownership of the firm and so forth. So In Adam Street's case, actually, there's 4 elements to compensation: base salary, bonus, a carried interest, and then ownership in the firm. And we include, in terms of the ownership of the firm, everybody in the company, including my wonderful assistant, Chris, and receptionists, and so forth and so on. So that is very unusual. And that we started 24 years ago, actually, and that's really changed and made the culture of Adam Street, because people really feel it's a family, and everybody is in the same boat.
So is this collaboration, inclusivity that helped you to grow? Because your growth has been phenomenal.
Yeah, when I started in 1980, we had $60 million under management, and today we have $60 billion under management, so it's grown 1,000x since I've been there. But no, it's important that almost everyone in a marketing presentation would say they have a synergistic platform, and we say we have a synergistic platform. And it is real, but we really incentivize it so that we have 5 investment teams, a primary team that invests in other managers, so-called fund-to-funds. We have a co-investment team, we have a secondary team, we have a venture growth equity team, and we have a private credit team. And we have 15 offices. But despite all that, we have just 1 profit center and 1 bonus pool and 1 set of ownership units that everybody has. And even if you're not allocated carry directly, the firm has part of the carry, and that goes to everybody that has units. So that would include the legal team, the accounting team, the HR team, and so forth. So when there's a big win for our clients and therefore us, everyone in the firm can celebrate. So the whole point here is to minimize jealousy, and when there's jealousy between teams or people, then they stop talking. And it's very, very important in our case for each of these teams to collaborate together, and that really, really does happen.
This is such a great example. That's why it's great to have alumni to talk about how the culture can really make a difference. And talking about investing in people, I already see a question here. You can put in the questions, and I can read them. One related here, which is, with the abundance of opportunities in the workforce, what have been your biggest lessons in being an effective people leader and retaining and developing talent?
Right. Well, it's very popular today to say it, but, the word inclusivity, but we've always done that. And so, and that includes, when you think about DE&I, I hired the first woman to be on our investment team in 1986. So that was 38 years ago. And the first black investment professional in 1990. So that was 34 years ago. And Adam Street today, I think, is 46% female, which is a much, much larger ratio than other firms. Yeah. And when you think about the ownership of the firm, the latest number is like 61% of the ownership is with female colleagues or people of color. So that is a huge percentage. So it isn't just that they exist, but that they have a meaningful participation. So I think what motivates people is feeling that they have a say, that they have input. And so I do a quarterly Zoom with all of our new employees, and they're from all over the world, with offices in Asia and Europe and so forth. And they might have been with us a week, or they might have been with us a little more, or they might be a senior person or a very junior person. But regardless, particularly if they're younger, I say, we want you to speak up in meetings. You might have insights and friends and relationships that the senior partners don't have. You might have been so involved in the data room and doing analytics that you have more insight into the numbers than some of the senior people might have. And so we do not want you to sit there and think, oh, this is a stupid investment, and not voice your view. So all investments have pros and cons. So there's always a discussion and a debate. And honesty and integrity is very important, and I don't mean that just with clients, and we've lived that our whole lives, including at client conferences. If valuations are high, we're going to say it. But we also mean it internally. So we want people to be honest with each other, and this is part of what I was just referring to. Let's speak up in meetings and not in the hallway, then grousing about something you didn't agree with. Let's get it out together on
That's
the table.
fantastic. And this is exactly what I always say. We talk with Kellogg alumni, and you so represent the Kellogg spirit. That's a great message. But I want to ask you, so you've been clearly a pioneer in terms of style of leadership and culture of the company, but you've been also a pioneer in looking at venture capital, private equity. These days, everybody talks about it. We have tons of students who want to go in there, alumni. But 1980, it wasn't that much, most of people wouldn't have known,
exactly,
right? Why did you go into it?
Yeah, people ask me that all the time. Well, I graduated from Kellogg in '76 and went into the investment department of a Connecticut General Insurance Company, which managed, lots of money internally, as all insurance companies do, and was doing private placements of debt and equity, and also managing a bond portfolio. As portfolio manager and trader, and you might remember interest rates from '76 to '80 skyrocketed, which meant bond prices plummeted, and I'll give you some numbers in a second. And so actually I thought about going into venture capital, and I'm serious about this, is doing something less risky than trading bonds. And something that had a longer-term horizon and sort of the minute-to-minute nature of what's going to happen to the shape of the yield curve and monetary policy and money supply and fiscal policy and so forth. And also something where I felt I could have more impact at the company level and working with management teams or the general partners and so forth. So those were the reasons I was attracted to venture capital, and I use that word because in 1980, the bio business didn't exist. People can't believe that today. But Adam Street started in 1972, Francesca, so this is our 52nd year. And for the first decade or more, almost 15 years, it was just venture because there was no bio business. So last thing about the numbers I referred to, when I started in 1980, people today think interest rates have gone up a lot, from zero, of course, to, a higher number. But in 1980, the 3-month Treasury bill was 14%.
We forget
and
these things.
And the 30-year on-the-run Treasury bond, where the 14 and 7/8 trading at a discount yield 15.25 yield to maturity. And they had 25 years of call protection. So you could have locked in a 15 1/4 return for 25 years, and people were concerned about buying them because they thought interest rates would never go lower. The AAA corporates, Southwestern Bell came out with a 40-year telephone bond, 17 1/4 at par. Prime was 21%. The price of gold was $800 an ounce, and the Dow Jones Industrial Average was 775. Not 1775, 775.
Wow.
So it's just,
helps to put in context.
Interest rates, discount rates, if you will, and multiples obviously are the inverse of each other, and so everything to do a buyout then with those kinds of rates could be done. George Roberts and Henry Kravis had spun out of Bear Stearns in '78 and were a fundless sponsor for a while, and then their first fund was the '82 fund. But but you had to buy things at very low multiples to make it work with those rates. So anyway, we've been through lots of environments.
Exactly. So talking about this, right? It's also that the industry has grown, but also became much more institutionalized, has standards. How did you help to establish the necessary standards?
So when I joined Adam Street in 1980, it was, we talk about venture capital and private equity as part of the global asset management business, and that it is an asset class like fixed income and equities and real estate and absolute return strategies and so forth. But 1980, it wasn't an asset class. It was really not even global. It was really just U.S. It was just venture. And it was sort of a ma and pa thing where different, real pioneers were raising venture funds, NEA, Kleiner Perkins, Sequoia, et cetera. But it was everybody was on Fund 1 or Fund 2, and a lot of great firms today didn't exist yet. So, to become an asset class, you need at least three things. You need to have valuation standards, which didn't exist. You need to have benchmarks, which did not exist. And you need to have, reporting guidelines. Is it time-weighted return? Is it internal rate of return? Is it gross IRR or net IRR? All that wasn't set. So Adam Street had taken a very large role in '85. I was the one that, with several others, that outside of Adam Street, that helped organize the first benchmarks report. And in '85, we had 13 years worth of data. And we, with three other institutional investors, contributed our data to get venture economics launched. And that was the first benchmark. And then in the late 80s, it took 2 years, but from 87 to 89, my boss, Bart Holliday, chaired a committee with 5 others, including the accounting profession, to establish the written valuation guidelines for the private equity and venture community. And then in '92, I was on a committee with the CFA Institute to standardize reporting guidelines. So
that's an incredible impact
so
you
we
had,
are
right?
very proud of the fact that that we did contribute to turning sort of a mom and pop other category into an asset class.
That's amazing.
Obviously, many others, were followed along, but we were right there.
Right there at the beginning.
Yeah.
Yes. I'm getting flooded with questions, but before I do that, I want to ask you one question that I had, and it kind of summarizes some people, right? Because private equity, some people think is all good, some people is all bad, and various things. What are some of the misconceptions that everyday investors have about private equity? How you think about it?
Yeah. Well, I would say, if I could turn your question around slightly, when I think about the media misconceptions or legislative or congressional misperceptions, and it could be investors as well, but most investors in private equity and venture, by the way, are very sophisticated institutions.
Yes.
And they do very, very, very deep due diligence, and so I'm very proud of this. We love it, actually. The more sophisticated the clients are, the better. And the result of that actually has been I think over 50 years, very, very few scandals in private equity.
That's true.
Well, that's why, because the reference checks and deep due diligence, it's done by everybody. But to your common misperception question, I would say 2 things. One, it's not opaque and mysterious like it's made out to be. Actually, we have, it may be to, I call it outsiders, but to people who are investors, we have more information on the companies and more access to management teams than you do in the public market. And so we have forecasts and we get all kinds of information. And general partners have annual meetings and advisory board meetings and so forth. And we serve on something like, 550 evaluation committees and advisory boards, so we even get more information than the average limited partner about it. But so that's one big misperception. There's less hope, if you will, in our investment decisions than I think there would be in the public market when you're investing in a single stock. That scares me more. Okay. Because we have more insight, and we literally can meet the management teams and get to know them and see what, develop confidence, if you will. The second misperception that the media often writes about is that it's entirely a very highly leveraged business, and it's not. Again, venture capital is a quarter to a third of what we do. There's no leverage in venture capital. And then a lot of what Adam Street invests in are middle market companies, and they're much lower levered in terms of transactions and ownership transitions and so forth than some of the larger transactions that might be highly levered. But even those aren't everything. Okay, it's more occasional. And the last thing that a private equity firm wants to do is to have a company go bankrupt and lose all their money. We're at the bottom of the capital stack. So that doesn't make any sense when somehow the media writes about the fact that it's a common practice for private equity firms to strip assets and highly leverage a company and leave it in the dust. It's not the reality.
That's the advantage of what you have, right? So someone will see one specific deal or one specific GP, and you have the entire horizon, and you can
Right.
put in perspective.
I mean, the other thing I would add is that in our 52 years, no client of Adams Street has ever lost money in one of our funds, which is remarkable. But it's not luck. It's the fact that since everything we do is private, it's illiquid. We can't undo it. There's a lot of very careful thought to portfolio construction. So people, this may be another misconception, think it's entirely a bottom-up business, picking the right management team, the right general partner. Yes, that's very important. But the top-down portfolio construction, I would say, is at least equally as important. And that, what I mean by that is time diversification is important. You can't control cycles going in or exiting 7 years from now, or technology cycles or whatever. And so we think very carefully about modeling and managing our client portfolios through time, by sector, and so forth. And and being highly diversified. Individually, venture capital has like a 43% loss rate over the last 40 years at the company level. But we still made almost, well, it's 2.7 times our money for the clients. So it's like a cup-shaped curve, not a bell-shaped curve. You have a lot of losses on one side and a lot of giant winners on the other. So it's different. And buyouts loss rates are in the 20s, low 20s.
Oh, that's
at the company level.
Yes.
But not at the but we've had zero at the portfolio level. Anyway, that's the secret.
And I see a question here is kind of related. It says, what ways do you see PE VC changing in the future? And this is something I also wanted to ask you, but there's also a question, it adds on saying, and how can Kellogg adapt to these changes to prepare our students?
Changes to the private equity and venture
So
industry.
how is the private equity and venture capital changing first? And then we can also talk about that.
Well, if you would have asked me in 1980 it was a very tiny industry then. In fact, in 1980, the calendar year 1980, only $1 billion was raised for the entire industry, and 3 years later, in '83, it was $3 billion, and people were wringing their hands over how could that much money be raised, So, and fund sizes were 25 million venture fund, $50 million venture fund, and I remember in 85 or so, 86, when we saw the first $100 million fund, and that was called a mega fund.
Yes.
Today, you wouldn't even. So anyway, and then it's global. I mean, there are like 25 venture managers in Vietnam. There's like 60 in sub-Saharan Africa, and this was true 10 years ago. So many countries and governments are very jealous of this really great smart capital efficient allocation mechanism that we started with in the U.S. It's now global, very big in Europe, very big in Asia, and I call it a win-win-win. So, meaning it's a win for the companies to have smart capital. It does create jobs. There's no doubt about it. Massive job growth at these companies, and looking across venture and buyouts. And then it's a win for the investors who have generated above average returns. So in terms of future, I would guess that it's just going to continue to become a larger and larger part of our capital ecosystem. Again, like I said years ago, I never would have dreamt how large it's become.
That's true.
And the opposites occurred in the public markets. In the mid-'90s, there were 8,000 to 9,000 public stocks in the U.S. Today, there's 4,400. It's halved. And so a lot more business is being done in private form today. You have a long-term horizon, you can do more things.
Yes, absolutely.
So I would, but I mean, I could get into all kinds of weeds, in terms of things that have changed. We have continuation vehicles, single asset continuation vehicles in the secondary market or multi-asset ones. And that's another tool in the toolkit for general partners that they want to keep an investment in a really successful business that they're on the board of and know, and then the limited partners have to decide if they want to take liquidity in that secondary transaction or roll their money forward in the extended vehicle, if you will. And so that's providing another liquidity option for the private equity and venture industry beyond just IPOs and M&A transactions. So, I mean, that's just one
example. The sophistication of the tools
so that's because the growth and the amount of money available in the secondary markets providing scale and liquidity that didn't exist before, even 5 to 10, certainly 10 years ago, but even 5 years ago. So that's the thing that I really love about it, is that there's always something new. I mean, particularly technology. I mean, the year before, in '94, nobody was talking about the internet.
Yes. So.
And then Mark Andreessen and Clark created Netscape with the browser in '95, and all of a sudden, boom, the whole internet bubble is off.
You have seen really the growth behind. Now, I want to read, there is a question, someone more critical about the private market. And it says, since the global financial crisis, private markets have been driven by cheap money and accommodating central banks. Are we due for a rationalization of capital? Can that also be an opportunity for leaders in the space to take advantage of that rationalization?
Yep, it's a great question. Now, in 2008, 2009, we didn't know that was going to happen, by the way. Okay, so that's it's a hindsight question.
It's true, yeah.
And I would agree with the question, actually, that we've never had a period where you had 12 years of zero or negative interest rates ever in financial history. And I love history in general, and financial history in particular. So it created, great distortions in asset prices, and not just company valuations, but farmland and timber and all kinds of things that have cash flows. Okay, so real estate, et cetera, and it peaked in 21. When there were the valuations were quite frothy, and so it's been quite healthy since rates rose in 22 to have a valuation correction in the public markets and in the private markets and in venture land in particular. So we've been through many cycles, but every cycle's different, and so you can't just say, because the causes are different. We didn't have a pandemic before. We didn't have 12 years of zero interest rates before. So we didn't have a Fed balance sheet go from 4 trillion to 8 trillion. So, and now it's now you have to unwind that quantitative easing with quantitative tightening. So the world has never been through all these things. So private equity has actually done, quite well through that. I mean, now venture returns for the last 3 years look terrible, but of course that means it's the best time to be investing now. And so valuations are way down and money is scarce. And what's good about the question is the word discipline is, back in vogue. And it's not just us as investors, it's the general partners have discipline, and the company boards and the management teams have discipline about how they spend their money and their cash. So it's a much better situation. But I don't see a major restructuring of the industry in some way. And like I said, compared to when I started, interest rates don't seem very high to me. It still seems like cheap money, actually.
You're right. And I have a series of questions. I'll come back, but there's so many interesting questions. You mentioned, you've seen the rise of the internet, you've had the technology. There's a question here that says, how do you think the adoption of artificial intelligence and Gen AI will change the PE/VC market? Will it require fewer people? I guess it's both in terms of investments, but also how they operate. Also, right?
I doubt it's going to, in a sense, replace people somehow. It just seems every technology cycle that we've ever been through it's shifted where jobs are and what the skill sets are that's been required, but in that it creates more jobs, right? So So AI is going through a period where it's probably overhyped, or maybe that started a year or two ago. So you can draw a hype curve and like a sine wave and a reality curve. That's a sine wave, and right now the hype curve is much greater than the reality, but they'll cross. And so I think it is going to be like the internet. You know, it got overhyped at 95 to 2000. Then there was a, you know, bust correction. But in the end, the internet's become, you know, much more transformative than anything we would have guessed 30 years ago. And I think the same is true with AI. Ultimately, it's going to be mind-blowing. But all these pieces had to be in place: cloud computing, machine learning, et cetera, et cetera, et cetera. So
that's a great insight. And let me take back to one of the questions I really wanted to ask you, because it relates to what you've been talking about, the fact that you've been having long-term relationship for a long time, right? Whether it's raising money for institutional investor, or you mentioned as being one of the first treating GPs as a real client. So how do you maintain this relationship?
Well, I mean, that's an easy question. I mean, we've been with TA Associates for 45 years, okay? We've been with NEA for, you know, almost 40 years. We've been in Benchmark's first fund in 95 and Andreessen's first fund in 2009 and so forth and so on. So,
and now they have a lot, so they could, maybe at the beginning they needed you, they don't need you anymore, but they're still with you, right?
Well, they never forget I mean, Matrix Partners, Index, I could name a whole long list of people that were with Kleiner Perkins and so forth, and then all the equivalents in Europe and Asia and private equity. So, no, we just work very hard at being a good partner. We don't take anything for granted. And we try to, you know, we again, in this sense, provide services because we're a direct lender to many general partners, their portfolio companies, when they're doing, you know, in the middle of a transaction. So we're involved as a, you know, senior first lien private credit lender working with the GPs side by side. We're also an equity co-investor with them in many transactions where they need more equity capital side by side. We are buying secondary interests in their funds when other limited partners want to sell. And, you know, we're a large primary investor, and many of these funds are oversubscribed now, including in China, even today. And so the loyalty and the longevity and the long-term view, you know, helps a lot in getting more insight and information and better allocations, and even references to brand new funds and spin-outs, you know, that we follow up on.
People.
And so because of our history, we've always been willing to do first-time funds and think ahead and be in the first close. That's another answer to your question. We're not waiting to see if the fund comes together. We're helping the general partner by getting to a first close, by making a commitment early. So, and we're not waiting to the fourth fund to see if they're successful, you know. So because we started, I didn't really mention this, and it's critical. We didn't do fund investing until '79. We started doing direct investing. From '72 to '79. Remember, it's all venture. So all we did was venture direct investments for the first 7 years of our life. So in this sense, we were the general partner. So we've had, you know, much more of empathy than the typical limited partner might have to what the general partner has to go through.
That's very interesting. I didn't know about that.
The other thing I would say, back to the people side of it, it's a very fine line between success and failure of a portfolio company. I mean, I've seen so many cases where the recruitment of one person, it could be a CEO, it could be a key marketing person or a key software programmer, broke the code, if you will, and made that company, had to pivot slightly, but made that company successful. And if that one person wasn't recruited or joined the firm, it might have gone under. And so, you know, yeah, it's great to look at a, you know, data room and say, oh, okay, this is a big winner or whatever. But when you get behind it, you realize, you know, every company's had difficulties. And so, we're not buying securities, and well, we legally are, but you know, we're buying businesses. So it's like Warren Buffett. You know, we have to think about the whole, and if things aren't going well, it's up to, we can't just sell and go on to the next thing. So we have to take, you know, help fix things.
That's so interesting. And actually, really, there was a question here asking. Okay, I have lost. Sorry. Can you talk about what's most important to you in terms of both choosing and operating companies such that they grow a lot?
Well, let's see. Well, generally speaking, we're involved in companies and industries that are in growth or dislocation or change in some fashion. And so, and this includes buyouts and ventures. So broadly speaking, that's going to be tech-related things, software-related things. That's going to be healthcare-related things, and that could be medical devices or pharmaceuticals or whatever, or business services for healthcare and so forth. And the two fields are blurring, actually, since there's talking about AI. That's helping a lot of medical companies.
That's true.
With Radiology Partners is a great example of that. So, company using AI. So, anyway. It's really exciting to see how these things are developing.
So you look at that and think of the future and then look at the potential.
So that's another thing you talk about leverage. The most of the business, again, we're focused not so much on large buyout funds, very large transactions, but more middle market companies, and through directly or through the general partners, and so. That's been true for decades and decades, and it's not as easy as it used to be because more companies are very well managed today than maybe 50 years ago. But there's still more you can do with a mid-sized company than a very, very big one. And so, and then there's another exit route, and that is to sell to a larger private equity firm too. So, it's generally speaking all about growth.
That's amazing. Now, I want to ask you something slightly different. Like, you're very well read on the history of financial institutions. You just showed it a moment ago, quoting all the numbers about interest rates at the time. And actually, every time I talk to you, I don't know how you remember all these things, but you really have a phenomenal attention to these things. Is fascinating. At the same, so you have an incredible depth of knowledge. You also have, as Adam Street Partner, offices all over the world. There's a lot of information coming. How do you process all this information, and how does it inform your view of the future?
Right. So I love history, and
I know.
and I love trains too, as an aside. But that's very relevant here because over many years I've read lots of books and articles on specific railroads in the U.S. and Europe and elsewhere. And of course, that they go back to the first railroads in the U.S. were in the 1820s, and so the U.S. as a country and the West, if you will, the Great Plains and railroads all kind of came together. And so they were under construction. That required capital. It was one of the first industries, because the whole business, the world was an agrarian society then, and we're moving into a manufacturing age, of course. And now more recently, like 50 years ago or whatever you want to say, we've moved into an information age. So agrarian society, manufacturing, information age, big transitions. But I've read about all these panics in the U.S. There was a panic in 1837, one in 1857, a big one in 1873, another big one in 1893, another one in 1907. And so, in construction of the railroad stopped, and the panic of 1873 was a financial crisis, and most similar to the global financial crisis in 08. You just substituted land for housing, and it was identical. So it took 4 years to recover from 1873 to 1877. Now, the reason I bring all that up is nobody remembers any of it today.
Yeah.
And the point is...
Except you.
Except the point is that when we were going through that crisis in 08 and early 09, I said to our team, 15 or 20 years from now, nobody's ever going to remember this. Now, and people looked at me like I had four heads, right? But here we are in 2024, and it is somewhat of a distant memory.
Yeah.
The details of it, and so so I think that allows us to have sort of a steady hand on the tiller to continue to invest. During down times when it is truly really scary, and when valuations are low, they're low for a reason. It isn't, markets are rational, and so, but you just need to keep not so the point is not to get too optimistic at the top, which often happens emotionally with people, human beings, or too pessimistic at the bottom, just to keep a steady hand on it. So that's part of the answer to forming our view. And then globally, we have offices in Sydney and Singapore and Beijing and Tokyo and Seoul, each very different, and similarly across Europe and North America. And we have some people at Adams Street, and this was true 20-some years ago, from like 30, 35 nations and speak 30-some languages. And that was intentional on my part in the 90s as we were going global, is not to send Americans to Europe or Asia, but to hire locals. And we knew that meant we were going to grow more slowly, and people with private equity experience were harder to find 30 years ago. But London Business School was very good to us. We had a number of great hires from there in the 90s. And so so we're a mini United Nations. I mean, our total employee base is like 340 or so today, but that geographic diversity and language diversity has been fantastic, and it's really helped us to have, more empathy and insights globally to everything that's going on in terms of, global tensions. I mean, as an example, we've not pulled out of China. We're still investing in, what we think are some of the best companies and best GPs there. Now, we're very concerned about it. It may not, be as our clients might have some effect on us because they may not give us as much money for China as they would have 4 or 5 years ago. But we're still committed to backing the best GPs there. And things I think are turning around there, actually. So there's only the government's trying hard.
It's very interesting because I know you're such a global business and so diversified, but it's interesting to hear how you were intentional on it from the beginning. It just didn't happen. Now you're talking about investors being, were they worried or not? I know you survey Adams Street investors regularly. What they are today most concerned or excited about?
Right. So when rates went up in 22, which I don't want to pat ourselves on the back too much here. I'm sorry. It sounds like it.
No.
I don't mean it. I don't mean to.
But, I know you are a true humble Kellogg.
We were forecasting that, I would have thought years ago rates would have gone up. So we were wrong in that sense. They stayed low much longer than we would have ever dreamt. But we did think when they rose, they would rise quickly.
Yes.
And probably more than people would think. Oh. So we took a very defensive posture then, for years, backing lower GPs with lower leverage strategies and companies with lower levered balance sheets. Okay, so that's part of it. But that's so in terms of concerns, Today, so deal activity slowed down dramatically when rates rose and valuations dropped somewhat. Public market valuations dropped a lot, comps dropped a lot, IPO markets essentially still shut for several years now. Mm-hmm. And so the biggest concern is liquidity back to the clients, back to the limited partners. And that affects everything, because if you get distributions back, it lowers your, if I'm Northwestern's endowment, it lowers your, exposure. Absolutely. And so you want the cash flow back to meet other obligations of an endowment or a pension fund, A, or to fund commitments you've already made, B, or C, to get your target allocation back in line. Because the other asset classes have dropped more than we have, if you will, in private equity. And so it takes time. So that's the biggest concern, liquidity and distributions. It's coming back, but slowly. Yeah.
I have several questions. I'll apologize. I already see I won't be able to get to all of them. There's one. What are your views on the current U.S. economy? Your views on 25 and beyond?
I don't have this will sound terrible, but I don't really have a strong view. And in some ways, what happens next year, I'm not terribly concerned about, because I'll try to answer the question in a second. But, I mean, I think we're going to muddle through the way we've been. Okay, so I mean, it's been remarkable, actually, that the Fed has been able to, despite very stimulative fiscal policy, okay, with giant deficits, been able to, muddle through by bringing inflation down and give credit to other central banks around the world, in England and Europe and Japan and Beijing and so forth, to bring inflation down and not have a big recession, and unemployment still strong and so forth. But the reason I said what I did a second ago is not being too concerned is that we're making investments today where we're going to be in that company or that partnership for a decade. And so what happens next year doesn't really matter. And so am I following the election? Yes, but is it really going to change what happens, in a major way? Some policies are going to change somewhere, but it's not going to change the GDP growth of the economy in any way, really. And actually, stock markets really haven't,
No, they haven't fluctuated
right.
a lot. So here there's another question. So we would say, I am benefiting and appreciating the session on successful PE investing. And this is, what are your current view on the most promising industry sectors?
Here,
I guess in the U.S.
Well, it's hard to say. I mean, because new things keep getting invented, which is really cool. And like I said, the year before the internet burst onto the scene, nobody was talking about it. All the puzzle pieces were together for it to happen, but as a thing. And anyway, Mark Zuckerberg founded Facebook in 2004, believe it or not, 20 years ago.
Yeah.
And nobody would have guessed, the year before that, what social media would be like. And so I'm always humble about trying to say, what it is, because they're going to be, because 12 months from now, it's going to be something really exciting. But again, we're continuing to invest in, many software-related things. Software, well, when I say let me answer it this way. We used to think of technology as a vertical. We don't think of it as a vertical anymore. It's a horizontal, because railroads used to, every business, farming, agriculture, our family farms in central Illinois, and our tractors, when they're hooked up to planters, have 5 computer screens in them monitoring everything with sensors. And I was riding on the combines last week on our farm, and they have at least 4 or 5 computer screens in the combines giving you real-time data on the yields, and they map it, so you can see if there were spots where there was less productivity or more productivity in a field, and it might correlate to some low spots or high spots, and it depends on the weather, and if there was a pond there that drowned out part of the crop or whatever, but then you can address it. And so anyway, the technology is in every industry everywhere, and so that's also powering great productivity and insight. So that's the neat thing about private equity and venture, is that, more than fixed income or real estate or even the public markets, we get to invest in new technologies that are coming out of great universities like Northwestern. And
that's a great insight.
So and the companies are being kept or held private longer, and so we're also a beneficiary of that.
It's very interesting. So
nothing to do with bond, right? This is just how everything is developing.
That's true. So given that, right, this view, what advice?
I just feel very lucky, honestly.
Well,
I go home every day and think we're blessed to be in this asset class in this sense.
Yeah, but it took some vision to invest in it early on, right? So, but I want to ask. So, when you have this early career professional, because as you say, at the time, not many, but right now, so many people. We have so many students or young alumni. They want to enter in your industry. industry, right?
Yeah.
What advice would you give them? What qualities are useful?
Well, it's sort of the Kellogg.
We are glad, exactly.
You know, low ego, high impact,
Great.
and all these things. Those are that's a really good answer to your question. So, as we've talked about before, collaboration, teamwork, partnering, helping others. It sounds, it's like motherhood and apple pie to me, but it's not just a private equity answer. I mean, that would be true no matter what industry you're going into, if you're in consulting or lawyer or whatever. I think it's very, very valuable. And to ask questions and to grow and to learn and to again, be, I'd say humble about what you know and so forth and so on. So people skills are very important. And because of the pandemic, many students coming out of high school, college, and graduate school have not had the same opportunities to develop the people skills. And so that's something that we notice and many others notice with younger people coming into the workforce. But we want everybody to work together and collaborate. So
given that you brought up also exactly the Kellogg mantra, how would you say your experience at Kellogg helped you shape as a leader, as a professional in your career?
No, it's one of the reasons I'm so excited to participate on a lot of committees at Kellogg and so forth.
We are very grateful for that.
Give back financially as well, because it totally changed my life. It was totally changed my life. And we didn't mention it, but I went to Northwestern undergrad.
Yes.
And I was in an experimental class of 3-2 students, and there were about 10 of us. And so I actually got into Kellogg as an undergraduate junior. I'd finished all my requirements for graduation at Northwestern. I was an economics major, except for being there a fourth year. I did all my hard stuff first and saved the easy stuff for last. And this was, so I started Kellogg in the fall of '74, and it was, I remember the stock market peaked in '71, and it went down every year I was at Kellogg, actually. And so when people when I said I wanted to go in the asset management business, they looked at me like I was crazy, because you want to go into Wall Street where you're a middleman, not actually managing the money. But I wanted to do that. So anyway, Kellogg changed my life. I mean, Northwestern does not have an undergraduate business school, and I knew that's what I wanted. I didn't know where or what that meant in terms of where in business. It's a giant field, obviously, but when I got to Kellogg, it was a lot harder, a lot more work, a lot more hours. I never worked so hard in my life. But I loved it. I got some, because it was. I realized it was like, oh wow, these are the courses I really enjoy: organizational behavior, or leadership, or even accounting. I hadn't had, finance, balance sheet.
So it opened new.
Yeah, marketing. I didn't, know about marketing channels and advertising. Marketing is a giant field itself, obviously, in many different facets, and Kellogg was one of the premier marketing is one of the premier marketing schools in the world. So, and by the way, Dean Jacobs, when I started in the fall of '74, was his first year as dean.
Oh, is that right?
Yeah.
So you started with him. Oh, that is a piece of
Hall,
history.
now the Jacobs Center was just completed.
Oh.
It was a brand new building.
Wow.
And so I watched that be, constructed when I was an undergrad. So anyway. That was
so you have such a deep connection, exactly from the beginning, even as an undergraduate and so on. And as you mentioned, you've been, in so many boards and committees. You were the chair of the just finished Northwestern We Will campaign. Yeah. You've been incredibly generous with Northwestern.
Chair of the endowment, too.
And the chair of the endowment. Yes, we are very grateful the endowment is doing well. So what has meant to you this connection to the university?
Well, I think it's like anything in life. The more you put into it, the more you get out of it. And, I would say, in the 80s and 90s, I wasn't very involved. I was happily married to my wife, Holly, and we had wonderful children. And I was helping to, work hard and build Adams Street. So I went on the board of Northwestern as a trustee in 2004. So that was exactly 20 years ago this September. And I went on my first committee at Northwestern in '96. Actually, it was a venture fund, still exists, for the athletic department. So, and I helped co-chair some reunions. So it was a gradual start, if you will, when it, and then one thing led to another. So, kind of in the category of no good deed goes unpunished.
I'm afraid
if you're
so.
involved,
Yes.
then they ask you to do more, which I've enjoyed doing.
Now, we are running out of time, but I just want to, there was an interesting question also here. Like, can you think of one or two formative moments that helped you to become the leader that you are today?
Well, one of them was, the creation of Adams Street. We spun out of UBS Brinson in the fall of 2000. And that was clearly a formative moment. It was the same clients, same investments, same colleagues, and so forth. But they had to resolve a Bank Holding Company Act issue, and that the resolution of that was the creation of Adams Street as a legal entity, and where UBS was a minority investor, and that's for a while, and we bought that back in 2008. But that's when I became CEO, and my boss, Bart Holliday, was retiring, and Gary Brinson, who was our president and CEO and chief investment officer of all of Brinson Partners, was retiring, and so forth. So that was again a very friendly situation, but that was clearly a definitive moment. In terms of now having our own business that was 75.1% employee-owned. And as I said earlier, we allocated ownership to everybody. So two things I would finish with. One was I realized as my career progressed that I was in fact an entrepreneur. That what I really liked doing was building Adams Street. More than I realized in the beginning. And so that wasn't something that I thought about or had as a career objective, but it became one. And the second thing that's highly related is, ironically, through my whole life, I've never had a goal to make a lot of money. That was never one of my priorities. I always thought if you did a good job, that would be a derivative, and that somehow would happen. So that really, but that always changed my thinking, because I wasn't trying to climb the ladder. I wasn't trying to elbow anyone aside. I wasn't trying to, go into my boss and get a raise or a bigger bonus or whatever. I just wanted to work hard and do the best job I could at whatever I was doing. And even in my self-evaluations, people were astonished at this, even though you have to do it every year and write about if you accomplish your goals or not and why and so forth. I would write a name in writing all the other people that helped us accomplish our goals in my self-evaluation, because I just always thought about that. There's no I in team, right? So it's always about a group. But because I did that, everyone, and I was, everybody was, wanted to work with me. I'm going back 30, 40 years, 20,
well, they still want to work with you,
right,
so it stayed. Right. But I do find it, and this is why, in a way...
And then the bottom line is I've made more money than I ever dreamt, when that wasn't the primary objective. But because the whole did well, okay, including the clients, most importantly.
And that is, this is why I love to do this conversation and meet someone like you who's been so successful in so many dimensions, and learn, right, that behind is, first of all, a phenomenal knowledge, which is great, but also especially the culture. I always say, when I talk to someone like you, the Kellogg spirit comes alive, right? And wanted to do the right thing, wanted to recognize other people, and that's amazing. And I have to say, I didn't say in the introduction, but I want to finish with that, because that recognition of people and inspiring comes, you come back and talk to our students and mentor them and give them insight on coming into private equity all the time. So we are so lucky to have you. I'm so glad I could share your knowledge and your approach with everybody today. Thank you so much.
Thank you. I'm honored.
Thank you.
Appreciate it.
It's been amazing. Thank you.
Bye.
Bye, everyone.